A very good afternoon to you and welcome to today's edition of Joy Business Masterclass. Masterclass is powered by Joy Business, and Masterclass comes your way every Wednesday at 1:30 p.m. runs all the way through to 2:15 p.m. here on your superstation Joy 99.7. My name as always is Yaw Anim Barnafo, and I'm glad to be your host for today's edition of Masterclass. In the last couple of weeks, we've been talking about taxation. We looked at taxation on foreign income last week. A rather interesting conversation, because in that conversation, things like double taxation came up. If you're a Ghanaian, you're living in Ghana, or you're a resident in Ghana, but you also have a job, let's say a remote job somewhere in the world, or let's say you have a business, and you keep traveling in between Ghana and that place, and you earn income from there as well. Well, the position of the law is that all the income you earn must be taxed. The conversation was, where does it get taxed? And we shared some brilliant thoughts on that. Three things stayed with me in that conversation, and I'm sure that our resource person will add a bit more to that once he gets underway. But here are the three things that stayed with me for those of us who missed that conversation. First was this, that there are situations which present the possibility of double taxation. And in those cases, a predetermined arrangement kicks in to prevent the occurrence of double taxation. And this is the existence of what is referred to as the double taxation agreement between countries. So you're a Ghanaian, you're working in Canada, you have a job in Canada and a job in Ghana as well. When you earn income from those places, there's a position of the law to treat the income you earn from those places. And this is under what we refer to as a double taxation agreement, or the DTA. Now, Ghana as a country has entered into double taxation agreements with a number of countries. And examples of those countries are countries like Belgium, Denmark, France, Germany, Italy, Mauritius, the Netherlands, Singapore, and a few more countries, which I'm sure that our resource person will share once he starts his delivery. And the third thing that also stayed with me is that Ghana derives its double taxation mandate from Article 75 of our Constitution for all double taxation agreements that are reached or that are to be reached. And the process is that they must be ratified by Parliament with a vote of nothing less than 50% of parliamentarians at the time of the vote. There were a lot of questions last week. We tried to field all of them, but if there are any questions you had on double taxation or earning foreign income which was not answered, please, when we get interactive, by all means, do reach out to us. Today, we're moving the conversation a bit further. We're going to be looking at taxation of property and real estate matters in Ghana, the positives and the negatives. Today, when you ask people, what do you want to invest in? Everybody says real estate. You're earning income from there. You have a property, 8-story building, or let's say a property that has about 3 buildings, 4 buildings. You're taking rent from your people and you're collecting the money directly. They're not even paying through an account. Should you be paying tax on that money? We'll get some information today so that we do the right thing. Back in the studio with us, we have should I say, I'm beginning to refer to you as a friendly tax consultant. Kwashie Awuttey is back here in the studio with us. His CV, I won't spend time reading his CV again because it is intimidating. But he's a Ghanaian of renown, very well versed in what he does. He lectures in about 4 universities. He's got all the tax qualifications that you can think of. And so, Fred, you're welcome back to today's conversation.
Thank you.
Today we're talking about taxation on real estate and property
Sure.
in Ghana. Talk to us.
Thank you, Yaw. I think yes, last week was quite fantastic. I would have wished we continued with double taxation agreement because there's so much we have to deal with. But taxation has several angles and several branches, so we have to veer off to taxation.
Once we get interactive, if there are questions from what we discussed last week,
Sure.
we will fill them as well.
Exactly.
Yes. And we're also streaming live on Facebook for those of us who like to take notes. Fred has obliged us some slides as well, so if you want to make some notes, please follow and go to our Facebook page and be a part of that conversation.
Great.
Yes, Fred.
Okay, thank you very much. So, just like you rightly say, we want to look at the taxation of real estate properties and properties in all and real estate properties and other tax issues. And you should be aware that the tax law makes it that any benefit that accrues to you, you are supposed to pay a percentage of that to government. So, if you receive rent, you receive your real estate developer, and you buy and sell properties, or you buy and rent the properties, or you want to buy the property, keep it for some time, hold it for investment, and then you sell it later, or you are in a rental arrangement with somebody and then you want to surrender your rent to another person. So what are the tax implications on those areas? So we'll look at the various tax types that affect each of the transactions. We'll also look at what are the some real estate or property transactions which are mostly affected when it comes to tax matters, and then maybe we'll look at the downside and the upside for it. The upside is that government have to take their revenue and then manage the country for us. So we'll look at that. Then, so let's look at specific tax types which commonly affect real estate and properties. Just like any other business, you always have taxes like corporate tax. I mean, you once into a business, you have to pay a corporate tax, and then also taxes like value added tax. VAT would definitely affect, because VAT VAT normally is on consumption that you have made, and the law makes it that if you rent a property or you are paying rent, I mean, the person charging you the rent is supposed to charge, and that is a supply of goods. I mean, the laws look at it as a supply of service. So to the extent that you are actually providing or renting a property to somebody, the law look at it as a supply. So, and the law says that anybody who make a supply which is taxable, which is not exempt, then you have to pay the correct tax for that. Then another aspect of the tax which may affect transaction is capital gain tax. You are an individual or you're even a company, and then you have a property that you are selling. I mean, in the future, the law says that once that property becomes an investment property for you, then on the basis of that, you have to pay a capital gain. Also, we'll look at that, how it affects the transaction, how the capital gain may be even calculated in one way or the other. So we'll look at that in a bit. Then another aspect which people always worry is withholding tax. I'm renting a property to a company, and I'm giving them about 100,000. I mean, they're paying me 100,000, and then they have to take about 15%.
It used to be 8 for residential and 15.
Yeah, it's remained the same.
It's still the same.
So 15%, but somebody will say that, oh, I am an individual. I mean, will I have to withhold, or I've just rented a property to somebody and GRE just come to me that you have, and I've been renting the property for 5 years, and nothing has happened. Now they ask me to go and pay.
When I was buying the cement, I paid tax on value added. When I built it and I'm renting for the first time, I paid tax. Every year when I take rent, I should pay tax again.
Exactly. So now another tax that which you have to be very aware of is that if somebody give you a property, like your father, your parent give you, or maybe your friend, so come on, I'm giving you this property. I think you've done quite very well. So you helped me in the past, so let me give you this property. So you should know that it's not free. You have to go and pay gift tax on that aspect. And just imagine, I mean, you don't have any money. Somebody has given you a property value about maybe $200,000, almost close to about $2 million or $3 million Ghana cedis, and you have to go and pay gift tax about 25% on that value. You can see, I mean, the impact that it will have on you. So let's move further. Let's look at some terminology. When you're looking at real estate business, basically you are looking at buying, selling, renting of real properties, such as land, building, or housing. So in this case, once you're into this business category, we'll say that you're into real estate arrangement. So there are people who may not be a real estate, but they're actually dealing in property. So the tax also cover them. So this may include issues like construction, renovation, buying and selling of real properties, including land, premises, offices, and industrial facilities. So all these things will be involved. And the question is that who is a state developer? How does the law say that you're a state developer? The law says that once you're into a business of renovation, you're into a business of construction, you're into a business of supply of property, then you are a real estate developer. And for that matter, the law makes specific provision for real estate developers. Now,
so that's a legal definition.
Yes, from the VAT Act. Now, what are the category of transactions that real property will be taxed? Mm-hmm. So if you're into construction and buying, there are tax implications there, and we sell the property, there are tax implications there. Then you are into commercial renting, or you're into domestic renting. So that one too, there is tax issues there that we'll look at in that regard. Or you are commercial establishment. Can you see if you have a hotel, and you're renting, it's a property that you have, and you're renting it, but in the form of hotel arrangement, that's a tax.
So every time someone comes to pay for accommodation at your hotel,
yes,
There is
There's a tax issues.
Yeah.
There are tax issues in there. Then you're also into property management. I mean, somebody has put up a building and then you say, "Oh, you come and manage it for me." There are tax issues. They get it. So in this case, what are the tax issues that we have to look at? So we'll look at this one after the other.
Is there anything? Anyway, I'm just being mischievous. I was going to say, is there anything you do in this country that you don't pay tax? Well, I'm in this country because Ghana is my country.
Yeah, there are some. I mean, the law has given some exemptions to certain taxes, certain income, which I not say that this one I'm not taxing. For example, when you walk to the filling station and buy petrol, there's no VAT on it. so some items are not. Once you take throttle, there's no tax on it, except that when you wanted to go to the higher class, want to take the plane out the aircraft, then in that case you pay some VAT.
Yeah.
So yes, so there are some items with the law exempt, even income tax. I mean, there are certain transactions which are not subject to tax. So not everything which are subject to tax per se. But the rule is that once the law doesn't mention it, everything is taxed.
we should all just go and live in our villages.
You'll be surprised. By the time you get to the village, the tax will change.
Anyways.
Then also you have purchase of property down, and then you hold it down. Okay, 3 years time the property value will increase. You see, then you have that anticipation that the property is going to increase. Yes. So you're not selling the property you're not selling the property frequently. In this case, you don't have the profit motive to trade in that property. Or the mode of financing of that property does not suggest that it's a business. So, or maybe the mode of acquisition of that property does not suggest that it is a business. So, on the basis of that, then that asset could be held for investment. So, if you sell that property as which we held for investment, there are tax issues on that aspect. So, we'll look at that.
Because you're receiving income.
You're receiving income
in that transaction.
In that transaction, and that is going to be a gain that you make on it. And most often, what comes there is capital gain. Capital again, and you have to pay about 25%. Very small on that. Now, so the rule is that a person who is engaged in renovation. So let's look at construction, development, and sale of which basically the real estate developers. Yeah. So let's look at what are the taxes which normally affect the real estate developers, and how can they look at that and make sure that they comply. Yeah. Okay. So the rule is that a person who is engaged in the renovation, construction, and selling of that activity will be subjected to value-added tax.
Right.
You have to pay value-added tax. And as to how the value-added tax will come is that the rule is that, you see, the VAT acts keep changing from time to time. So I think last year what happens is that the law changed and said that when you are a real estate developer and you supply good or supply the property, you pay a flat rate of 5%. Okay, so there it is clear. So you have to pay a flat rate of 5%. Right. Then, when you have sold the property to somebody, and let's say you sell it to an office, so the office has an obligation under the Income Tax Act, and say that okay, when you're paying that real estate developer, you have to withhold a tax. So on the basis of that, it's going to be a withholding tax implication on you, the real estate developer. And you'll be wondering why. I mean, I've sold my property, I'm going to pay my corporate income tax. And the law makes is that once there is a sale of or a transfer of or consideration received for transfer of rights in the property, in that case, you have to withhold a tax. Do you get it? So in this case, the law, formerly you pay about 7.5%, but now the way the law has changed, you have to pay 3% because the law says that once there's a consideration paid for transfer of asset, then you pay 3% on the the transfer of that asset. So now when you have actually sold property to somebody, a company, the company which is paying you must actually withhold 3% from that. And if the failure to withhold that, the company will be surcharged per the tax law.
I mean, I think I had a conversation with someone about being a tax agent of the government.
Yes, so you're withholding agent.
Because they're visible. I mean, institutions are registered as the RGDs.
Yes.
So clearly they're visible. And if they're dealing with you, then they have to do the proper thing.
Exactly.
Which is why when you're dealing with a company in a transaction, they'll give you the biggest business, but they will also bring you the biggest compliance.
Exactly. Yes. So now, let's look into detail on the VAT issues, you see. Now, when you supply the product, you are supposed to pay a charge 5% withholding tax, but that doesn't end it. The law also require you to charge what we call COVID-19, which is 1%. Okay, now the rule is that can I claim, when you are doing the renovation and construction, there are costs that you have incurred, and those costs you incur, let's say you're going to buy from the roadside, from the iron dealer and kind of things. They also charge you the VAT, so you have input costs. Can you claim it? The answer is no, because you see, you could have claimed it maybe some 2 years or some 1 year ago, but for now you cannot claim it because the law says that it is flat rate, and the law says that if it's a flat rate, you don't claim input tax. You don't claim input tax. So on the basis of that, you just charge the 5%, you charge the 1%, which is the COVID-19, and then charge 5% addition on cumulatively on the 1%, 1% plus the value of the property, the taxable value of the property, and then you pay to
and
the government.
And if the supply is in the area of telecoms, then you also do the communication service tax.
Yes. And then
the NHIL.
Exactly.
Oh.
No, but the NHL doesn't come here. Once it's
Right.
a flat rate, that you don't have any
Okay.
any issue. However, so if you are in the real estate business and you're charging a VAT, you charge a VAT at flat rate of 5%.
Right.
You're not entitled to any input tax. That's what the law provides. Now, but cut off if you're into any other business. Let's say, I mean, most of the real estate company, they have facility management aspect of it. So when you're into that facility management, do you charge a flat rate? The law said no. In this case, this one there, you charge the standard rate, which is 15% plus the 6% levies. So on the basis of that, you are going to pay a cumulative tax of 21.5%, 21.9%. But the question is that, can you claim any input cost that directly is, which is directly attributable to the product that you said, the supply you're making? Yes, the law says that any input tax or any input cost that you incur for which you pay the VAT, then you can claim the input tax on it, but only on those items which are not.
So it gives a specific list of items.
Yeah, no, it's anything other than the property you're selling.
Right.
Okay, let's say if you're providing facility management, you're providing security, any other things, which is a service. That one, it is at a standard rate. So you have to make sure that you manage this thing quite very well, so that you may not be influenced.
So just to clarify that, I mean, and again, I've had a bit of a conversation with a few of the finance people, and they've tried to explain it to me. So the distinction is among three main categories, which is whenever a transaction takes place, it's either a service, a good, or a supply.
Yes.
And there are different rates that apply.
There are different rates that
so
apply.
On these three, can you just use that to explain the point you just made again? Whether it's a service, because in the same real estate example, you can treat it in two different ways.
Sure.
Like what you just explained.
Yeah.
On the real estate bit, it's a flat rate.
Flat rate, yeah.
But if it is any other thing other than real estate, then the standard applies, whether it's a supply or it's a good or it's a service.
It's a service.
Right.
So as you say, we have service and we have goods. I mean, so if it's a service, normally it's standard rate. Okay. But but for now, you see, the law also said that renter, real estate people are so in rent. And the law said that once into the renting, it is also flat rate. So you could be surprising a service, but it's flat rate as a real estate person.
Okay.
So you charge 5% on that.
That's a bit confusing, because if someone has a property and they're renting it, let's say, to staff of a company.
Yes.
Is it a 15% which applies for withholding, or is it 5%?
That is, you see, we are talking about value-added tax.
Right.
Yes.
Not.
Yes,
okay,
not
not
so we come to the withholding tax aspect. So in that case, we pay the other name. You charge the flat rate.
Yeah.
There is no input tax on that. But if you're into any other business, I mean, like the facility managers, I keep saying, that one is another service, but it goes for standard rate.
Right.
Okay, it goes for standard rate. Now, the another issue which we may possibly be looking at is the withholding tax aspect of it. So when you're into real estate, the issue is that you'll be subjected to a withholding tax under Section 116 of the Income Tax Act. Now, formerly, the withholding tax could have been 7.5%, but because the law has changed, which says that when there's a consideration that you receive for transfer of asset or liability to another person, then the withholding tax is 3%. So in that case, I think there is a lot of reduction in this case. So you can that could be 3% withholding on that aspect for the business. So I think the businesses have to be aware of that and the kind of things. And then corporate tax, we know once you earn income and you have to pay the corporate tax. Now let's look at
what's the rate there, just for the education of those
25%. I mean, on your profit. In this case, so you calculate what we call chargeable income. If you have a problem, you can get a tax consultant who can help you to do that. And most accountants are aware of that. Now, the chargeable income is such a way that your assessable income. That is your income you earn, all your revenue that you earn, which are taxable. Then you take out all the deductions, which are the laws is that they are allowed. So after you take out the deductions, which normally are business expenses, then you arrive at the chargeable income, and the chargeable income is what you apply the 25% on. So it's very clear, very simple, but it comes with some complications. And I will always advise companies to, look for a tax practitioner.
Always get a tax practitioner,
to
a tax
help you.
professional, a tax consultant.
Yes, to help you
with your taxes.
Yes, other than that, you end up, paying a tax which you shouldn't have paid.
Yeah.
It happens most often in my practice.
Because I'm listening to you now and I'm thinking, if I'm a business and I didn't have the right information, I could be paying the withholding, I could be paying the VAT depending on what it is. I could also be paying the income tax on my declared profit. You need a tax consultant.
You really need a consultant and to help you in that. Don't just go to any other person. You have to be sure that this guy, this person, this company or this firm, we have accountant, we have tax practitioners. Now, so that is about real estate. Now you can be in real estate, but you'll be selling land. So let's say a person who sells a bare land or vacant land. What are the tax issues? So let's veer to another angle of property transaction. So you're just selling a bare land, or there's no bare land here. It means that there's no facility, no structure on the property, on the land. So you're just selling the vacant land as it is. So what are the key transaction, tax issues which will affect you? Now, the rule is that if you're selling an immovable property with, let's say, building and kind of things, it has a different tax composition, which basically normally will affect maybe a real estate person. But if you're just selling a land, a bare land, the rule is that if you're an individual, you're likely to be suffering about capital gain in that respect. You are likely to also be subjected to a VAT. Remember, when you're a real estate, the flat rate applies 5%.
Yeah.
Okay. But if you are an individual and you're selling a property for which you have made a threshold, the threshold means that you are registrable to pay VAT. Okay, you are registrable to pay VAT, which is 200,000. The threshold for charging VAT is 200,000. So the law is that once you supply a land which is a vacant land, then on that basis we charge a VAT of 15%.
Right.
Do you get it? But if it is sold by a real estate person, it could have been 5%. You get a decision.
Because application of the tax definition in this case under real estate applies to real estate people who are so defined by the provision.
Yes.
So if you are selling it and you are not a real estate person,
it
doesn't make you a real estate person.
It doesn't mean, but also there are provisions which say that if you also engage in a selling of immovable property, do you get it? In that case, you see, immovable property here, land was not included in that definition.
Right.
The land was not included in that definition.
So more like buildings and things like that.
In that kind of thing. So if you don't take time, you may think that the land is there, so it is going to be 5%. You'll be surprised. Yeah, they will come and then they will be auditing you. They will be applying 15%, and you're asking yourself. Then that you'll be asking that somebody has misled you. So you have to be very, very careful on that aspect. Now, so you have to charge a VAT of 50% once you are selling the bare land. The land which has no any facility.
So for all our people who are listening, entrepreneurs, business owners, you have a piece of land, the business owns a land. When you are selling it, there are tax obligations to be obliged.
Exactly.
And you must understand it and do it the right way. Otherwise, the GRA will come after you.
They will come after you. But if you're selling the land for dwelling or for residential purpose, then on that basis, there is no VAT issue. So the law has exempted
domestic or residential use.
Residential use or domestic use. No VAT will apply.
What about anyway, we'll get to the question. I was going to say, what about wrongful declarations at the time of sale?
No, you see,
that would change the tax.
That will change the structure and the nature of how the tax will be. And somebody will tell, I'm selling it for purpose of residential building. But at the end of the day, they really look at the indenture, they look at the agreement, they realize that no. The person who's actually buying is a real estate company who is buying the land from you. So you cannot say that he's for real estate. Or it's a company which is buying it for office purpose.
Exactly.
So on the basis of that, you have to prove. So you have to actually prove that there's not going to be any it's not good. It's actually residential property.
The use case arguments won't change after the sale.
Exactly. Now, but if, as I said, if it's a real estate company which is selling it, the tax rate is 5%. So that is the VAT is 5%. That is clear. But if it is for residential purpose, the real estate people to need not to charge the VAT, because that one is clearly exempted under the tax.
Right.
Okay. Now, are there any withholding tax implication? Yes. So when you sell the land, then the law is that the person who is making payment to you must withhold 3%, because you're actually transferring interest in that land to that person. So when the person is paying you, must withhold 3%. Now, but who should withhold? Individuals are not required to withhold the tax. It is only company. But the law is that a person other than an individual supposed to withhold the tax. So that is how it works. That's how it works.
Right. So the company selling it to you have the right or the responsibility to withhold.
Exactly.
Because they become tax agents of the government in the transaction.
Exactly.
But in a case where the sale is between two non-institutions.
You mean non-resident or whatsoever?
No, they're resident. But
I mean, a person. Let's say a person
two individuals.
Let's say two individuals. No, individuals are not entitled to withhold taxes. I mean, generally, there are instances where individuals will be entitled to withhold taxes. But when it comes to withholding tax, like this goods and service kind of thing, the individuals are not entitled, are not required by law, and obligated to withhold tax. But you can withhold it. I'm going to put
it. You said it very nicely. It's not because GRA. Good afternoon, if you are listening. I'm sending one your way. It's not because they are not required. Because you don't trust that they will come and pay.
That is right. But in some countries, I mean, individuals. But withholding taxes are very easy way of trying to collect money for government. Now, so if you're an individual, you sell a property, is there any capital gain issue? Yes, there's a capital gain issue. Of
course, there is.
So the capital gain will arise. Now, again, is just simple. The cost at which you purchase it earlier, and then the price at which you are selling it. But if you have incurred any other cost on that property, maybe repair, or you've invited some valuation officer to come evaluate the property, or you engage a marketing officer to market the property for you, all those costs, you accumulate them, and the selling value, you subtract it. The difference is a capital gain. Now, that gain, the law requires that you charge 25% flat on the gain.
Right. On the value of the gain, which is the differential between the cost, the value of it at the time of sale, and the cost at which you bought it.
The cost at which you bought it. Okay, so the time of realization, the value derived from realizing the asset.
Does that presuppose then that the capital gains tax only applies at the time of resale?
Yes, it only applies at the time of sale.
At time of resale?
Yes. So the time of resale of the property, then that is what the capital gain will apply. But there are two ways of treating it. Okay. Now you can treat this as a capital gain tax and pay 25%. But this you have to pay within 30 days from the date of selling of the
What
property.
if I purchased it for own use?
When you purchase it
like
for own use,
a company builds a head office.
Now, so you see, you are buying it.
You're building it for own use. Let's say.
Oh, you are building for own use. Yeah. I mean, that one is so you've not realized it.
Yeah.
So you didn't dispose it off.
No, you didn't.
So in this case, you don't. But if you dispose it off later years, then there's going to be capital gain.
Right.
Yeah, there's going to be capital gain, and you have
like
to.
Like you enter into a sale and leaseback kind of arrangement.
Yeah, something from that sort.
Then you are realizing some income.
Realizing some income from it, or you want to surrender lease arrangement. There's a realization on that aspect as well. So you can apply 25% on it, or wait and add it to your employment income or your business income. So you have to look at the options. Either you pay the 25% on the gain, or you add the gain to your employment income and then your business income and tax.
But what would inform the choice of
it depends. If you wanted to look at the exposure. So sometimes that's why it's very good to get an accountant to help you do that. Because if you want to charge it at 25% flat, then you have you pay just 25%. You know the personal income tax rate is up to 35%. So if you have some income from employment and you add the gain to it, it can throw you into a higher tax bracket.
Right.
So you have to weigh it and see which one give you a lower tax
minimal
benefit. So that is what you have to look at. But if you don't do it carefully, and Jerry come to review it, you're likely to be in trouble.
Good afternoon, Jerry.
All right. So, but you have to, when you dispose it of that, the law requires that you file a return within 30 days. Failure to do that, you'll be subjected to penalty payment. So, in that case, that can have a tax implication on an individual. Now let's look at leased property. So you are leasing the property.
Hold that thought for me on leased property. This is getting rather interesting because there are a few people in Ghana today who are also involved in the business of real estate. And even when you extend that conversation or that net to involve those who are in the business of renting, it makes it even a lot more people. And I don't think that we have all the information on what the tax position is. We want our listeners to be a part of this conversation. So we'll take a quick message from our sponsors. When we come back, we get interactive.
Your favorite on-air business development program, Joy Business Masterclass, is in session, and you can interact with us on Facebook via the Joy 99.7 FM or Joy Business pages. If you tweet, the handle is at Joy 997 FM or at Joy Business GH. Don't forget to hashtag JB Masterclass. You can also call us on 0302 216541 or send your questions and contributions through to the WhatsApp number 0551 111997, and our facilitators will address your concerns. Attention everyone, class is in progress.
Welcome back. If you've just tuned in, this is Masterclass here on your superstation Joy 99.7. We're here in the studio with Fred Kwashie Awuttey, Esquire. Phone lines are now open. Numbers to call 0302216541. That's 0302216541. You can also send us your comments on 05511119997. If you're driving, please do not text while you drive. We definitely want you to arrive alive. But otherwise, pick up that phone, give us a call. 0302216541. We're talking about taxation of property and real estate matters in Ghana, the positives and the negatives. Surely you are involved with, or you know someone who is involved in the business of real estate. And the law defines it very beautifully to include those who are in the business of renting property. I didn't even ask about agents. I'm sure we'll get there shortly. But I think I have a comment on social media. My comments have started coming in already. And the phone lines are also open. Just pick up that phone. Give us a call, 0302216541. This one is from Tema. It says it's from Ajingo the Man. It says, good afternoon, Mr. Barnafo. Please ask for me, what is the difference between property rate and taxation? Ajiman Joseph from Committee 9 in Tema. He wants to know what the difference is between property rate and taxation. But I suppose Ajiman Joseph wants to know whether property rate is a form of tax. Because as for taxation there, I can tell you on authority that property rate is a subset of taxation. Hold that thought for me. So he wants to know the difference between it. Okay. But I've got a caller on the line. Right. Good afternoon. You're welcome to Masterclass. Your name and where you're calling from.
Good afternoon. My name is Redeemer. I'm calling from Accra.
Good afternoon, Redeemer. Where in Accra are you calling from?
I'm calling from West Legon.
Right. How's West Legon this afternoon?
Everything is doing well.
Brilliant. Talk to me, Redeemer.
Okay, so what I wanted to find out is if your business is, let's say you have a property outside and you're selling it here, will you be taxed here? Because outside you will be taxed there as well. But if somebody buys it from here, are you to make a tax declaration?
When you say outside, you mean outside of the jurisdiction of Ghana?
Outside of Ghana, yes. The property is outside and you are selling it here.
Okay. Please keep listening. We'll answer that question. Thank you for calling us, Redeemer. I've got another caller on the line. Maybe we start writing the questions down. So, good afternoon. You're welcome to Masterclass. Your name and where you're calling from. Oh, I lost that caller. We definitely want to hear what you have to say, so please call us back. But let's take Redeemer's question. I have a property outside of Ghana. I'm selling it. How does a tax arrangement work? I think he may have missed last week's session.
He might have.
But if we can just answer that quickly.
Okay. That's good. If you are resident in Ghana and then you earn any form of income outside the country, the rule is that you'll be taxed in Ghana. Your foreign income will be will be subject to tax in Ghana. So if you have a property located outside the country and as a resident person, and then you sell that property, it doesn't matter who actually purchased and where the location of that person is. If the person is in Ghana and you purchase it, it doesn't really matter. What matters is that where is it? I mean, who are you? Are you resident or non-resident? So once you are resident, and then the properties or whatever income you earn outside the country.
I think his concern was he'll pay tax here and pay tax there too. But I think the answer to that is that if there's a double tax agreement between Ghana and that country,
so we don't really need to have a double taxation agreement. I mean, the domestic law make provision for that.
Right.
That if your tax in a foreign country on the foreign income, and Ghana will also want to tax the same income here. So the tax you paid in a foreign income can be used as a credit against the tax that will be paying.
So net you won't pay twice.
Yeah, you will not pay twice, but it depends. If Ghana tax is higher than that of the foreign tax.
I've got another caller on the line. Good afternoon. You're welcome to Masterclass. Your name and where you're calling.
Yeah, that's me.
Yes. Good afternoon.
Can you hear me, please?
I think if you can just reposition yourself for me very, very briefly.
Is it okay?
It's better now. I can hear you.
Okay, this is my Joseph from Summer.
Oh, Ajiman, you called me back. Brilliant. Talk to me.
Yeah, I want to clarify my question that if someone should pay property rate, is it the same as tax? Secondly,
Right. That's the question you asked.
Having a tax.
Okay. Right. Thank you,
How
Joseph.
is the person to pay tax? And also an agent for other room or land agent. Whenever the person buys, there's a percentage for him or her.
Yes.
How does the person register for tax?
Okay. All right. We'll answer that very briefly. I think we can go ahead and answer that.
Okay, that's great. Now, in Ghana, under Article 175 of the Constitution, it says that no taxation can be made or imposed without parliamentary approval.
That's correct.
So any levy you're paying anywhere, either district assembly or Ghana Revenue Authority, is a tax. So tax has a very broad spectrum. Now, Ghana Revenue Authority.
Property rate is a form of tax.
It's a tax. It's actually a tax.
Okay.
So you cannot say it's not a tax. So that if you come to Ghana within the domain of Ghana Revenue Authority, then they are mandated to collect certain aspect of the taxes. This is assembly also mandated to collect certain aspect of taxes. So on the basis of that, the property rate collected by this assembly is actually a tax, but it's a separate tax which is calculated on what we call retiable value of the property on annual basis. But when you have sold the property, then you fall within the domain of Ghana Revenue Authority.
Because you have realized income.
You realize income.
I think his question was more to, if I own it already, I've gone beyond all the sale, everything. I own it. And every year I pay property tax. Is there any other tax I'm supposed to pay?
No, if you own it, and I don't, from GRA perspective, no, you will not pay any other tax. It's only a property tax. But I think he was also asking, how can he pay if there's a realization of the tax? How can he register with Ghana Revenue Authority?
That's for agents of lands and houses, those who rent.
Okay. So
the
we'll come
percentage
to
they
that later.
receive.
Okay.
How can we do that? So maybe hold on to that. I've got a Kofi at Ashalebuche. Kofi says, good afternoon, boss. Assuming I build a 3-bedroom house at $150,000, including cost of land, and I sell it at $210,000. Okay, so 60K realized there. What amount am I to pay 5% flat rate on? Is it on a 60K or on a 210K? If it were capital gains, it would be on a 60K.
There are two tax issues which will happen
Yes.
on him. If he sell the product at 250,000,
No, he's selling at 210. He's built at 150.
okay, and selling at 210.
210.
The threshold for registration of VAT is 200,000. Okay. So you qualify to charge VAT for that transaction. Okay. So in this case, when you are selling it, then you charge flat rate of 5% on the VAT for the VAT. Then the capital gain, which is the 60,000, you charge 25% on that.
So there are two taxes he will pay on that.
He will pay on that.
Capital gains for the 60,
and then
flat rate of 5.
And then also
more than 200.
COVID-19 will also come in of 1%.
Kofi, DRA is coming for you this afternoon.
So you have to.
Phone lines are still open. Numbers to call 03022165541, 05511119997 is also the text line. I'd really like someone from DRA to call me this afternoon and, just to shed a bit more light so that Ghanaians can appreciate the tax position. Numbers to call 03022165541. I think there was a question the land agent's question.
Okay.
If we can just take that one as well.
If you're an agent and you are dealing in properties, and then you meet a registration threshold, which is a 200,000 for each any part of the year, during the course of the year, then you are supposed to register.
But if you don't?
If you don't meet, you don't have to. But any time at all within a year that you meet it, then you have to charge it. You have to charge it. And once you register every year, whether the year, the subsequent year you didn't meet it or did not meet it, once you register, the law requires that from the date of registration, you are supposed to charge the VAT until you deregister with Commissioner General.
So as for VAT, you will pay.
You always
But
pay.
if you don't meet the 200,000, then you're not required.
You're not required to register.
Brilliant.
And pay. So that is on annual basis or 12 months basis.
Okay.
Now there are other taxes which you're supposed to, which will happen. I mean, when you provide a service to a company, the company will be required to, withhold the taxes I mean, then in this case, you provide a service.
Yeah.
So once you provide a service from the perspective of the income tax act, you pay 7.5%.
Yeah.
Or I mean, they will be total 7.5% from the service you render.
Right.
Because agents don't sell a property; they sell a property for on behalf of another person.
And they take
So it is only their service
cut, yeah.
that I will be subjected to the withholding tax, and the person who is paying the service, if it is the agent, if it is the buyer or the seller. So it depends upon who is actually.
So admonition here on today's show is that if you're an agent of land or property, please register for VAT.
I mean, to have any problem, don't know problem,
Yes.
just register for the
Be a
VAT.
good citizen and register for VAT because Omeyi a woman, Omeyi a man. Phone lines are still open 0302216541. Surely you have a lot of questions regarding tax and how you should treat it. The better you understand it, the better your finances will be. As a business owner, as an entrepreneur, please pick up that phone, give us a call 0302216541. Otherwise, send us a comment on 055-1111-997. I have a question of my own. Is inheritance subject to gift tax?
Yes, I mean, formally, under that 592, when you inherit from maybe your father, your parent, in that case, you will not be subjected to gift tax. But the way the law has changed now, once you inherit anything, I mean, the law says that it becomes part of a gift. So you have to pay. And you're going to pay 25% on that. The question is that I get a property, I didn't even sell it. How will I pay that?
So for all those who are going to attend inheritance meetings this week and next week, please remember that whatever comes to you, you are supposed to pay gift tax on it.
Gift tax on it. I mean, if it were to be under the old law, no gift tax will apply. But under the new tax law, once you get any inheritance property, I mean, the law say that you have to. I mean, that becomes a gift to you. And there is no exceptions in the law as it is now.
Is this why, okay, I was going to say, how will the government track? But that's why wills are lodged in court.
It's very simple. Once the property is given to you, I mean, and then you register it in your name, GRA will pick it up from the Land Commission.
Interesting. Okay, I think I've got about 3 more minutes on the show. Phone lines are still open 0302216541. Send us a text on 055-1111-997. But there was some information you were going to share before we open the phone lines.
Okay.
So maybe
on the renter.
Yes.
So we I think within the next 1 minute.
Yeah.
So rental. If you're renting a property, the law is clear. I mean, if you're a real estate person, you charge the VAT, and if you are also not a real estate person, you have to charge the VAT, provided you meet the threshold. So if the rent you are charging is about 200,000 per year, and that is, but if it is so many properties, definitely you are likely to meet the threshold. So you have to. Now, what will be the implication for withholding taxes? So as we said, I think we have mentioned some aspect of it. Now, if the person you are selling to and is paying you, if it's for residential purpose, the tax rate is 8%.
Yes.
If it's for commercial purpose, the tax rate is 15%.
That's correct.
In that case, that you have to. Now, that is it for entity. Individual, the same thing apply. So individual, the same thing. I think that is what, because of the time, I mean, we just have to. The long-term lease. So when you have a long-term lease, that is a different thing. You see, long-term lease is like a long term of rent. Do you get it? So when you have
how does the law define long-term here?
Long-term here
1
will
year,
mean
2
that
years,
maybe
3 years.
No, sometimes most of you look at it from 10 years and above. Could be a
that's
long-term rent. Yes,
10 years and above.
Although there's no specific definition in the law, but most of you look at it from that perspective. Right. Now, when you lease those properties, it's like you are transferring your right in the property to another person. Temporarily. And the payment that the person is making to you becomes a capital payment. There are instances where GRA will say that, the payment is making, we pay, lease is a form of rent.
That's correct.
So we're supposed to be paid on monthly basis or annual basis. GRA will say that, it is rent. But you see, the law is that once you're making a capital payment, it's not a revenue payment, revenue expenses you are incurring. And the law, I mean, case law have defined it that once it's a capital payment, then you're actually selling the property. So on the basis of that, once you are giving out your right in the property, then the tax rate that will apply will be 3%. Sometimes GRA will say that, it's not 3%, it should be 15%. I mean, there are this dichotomy on the issue. But, I mean, if you look at it, the law clearly as it is, once you, under Section 116, once you transfer your right in the property to another person, 50 years, 30 years, actually you have sold the property. So, for that matter, the tax rate should be 3% in that direction. Then, let me draw your attention to surrender of a lease term, maybe The lease term was supposed to be 50 years. You have used 30 years, 20 years. You wanted to surrender it and move it to another person, or you have rented a place for 5 years. You live in 2 years, and then you want the landlord to refund you the remaining balance because you are going to another place. Please, it's not a refund. You are selling your right to the landlord back. And once you are selling your right to the landlord back, then on the basis of that, you are supplying a service, and then there are tax implications.
After my money has lost value,
Yes.
because the money I would have given him would have been
Exactly.
2 years ago.
Don't think that's a refund, because you have
When
the
inflation
right.
has happened.
Yes, you have the right in the property for
Wow.
the next 5 years or the remaining
I
2
can
years.
see Akofa looking at me funny.
Don't think that is a refund.
Wow.
So when GRE comes to you,
So newsflash: for all those who rent property for, let's say, 2-3 years, and you are leaving after, let's say, 1 year, and you go back for your money, the position of the law is that you are realizing income.
you realize income. So you are actually, you are transferring your right back to the person. And once you transfer the right back to the person, then you're actually selling that one to the person. You say supply. So it's not a refund.
I have no comment on that. That's what time will allow us. So what's our takeout from today, and what should we look forward to in the tax conversation
I
next week?
think
God willing?
there are tax imposition on property transaction. So everybody, any person who is engaged in transaction relating to property must be aware of those tax imposed. And I want to let one thing known to you. There is no presumption about taxation, and there is no inferences about taxation. The law always speaks by itself. So that is one thing you have to be aware of. And real properties are good investment. But do not let it work for you. Do not let it work for you and allow the taxman to take the money from you.
So get a tax consultant.
Get a tax consultant.
Understand the process properly. So you
yes.
don't pay the wrong taxes.
Exactly.
And it doesn't become
Or
a
you don't
tiresome-
not to say you don't pay the wrong taxes, but you pay the correct taxes within the tax
correct
law.
taxes within the tax law.
Yes.
I like that. Let's look at the positives. Thank you so much. This has been Masterclass here on your Superstation. God willing, we come your way with yet another exciting edition next week. Thank you for joining us. We'll see you same time next week.